Hello, and thanks for joining the Mint Diversified Funds market update for May 2026. My name is Alistair Dring, Assistant Portfolio Manager for the Mint Diversified Funds. Today, I'll cover off a few things. First, the macro backdrop. Second, what that means for equity and fixed income markets. And third, how that all flowed through to the performance of the Mint Diversified Income and Growth Funds during May. Please take a minute to note the disclaimer regarding this recording. Starting off with the US, not because it's the whole global economy, but because it remains the key marginal driver of global equities, rates, and liquidity, and particularly in the portfolios. On the surface, the US economy still looks resilient. After a softer patch last year, GDP's rebounded, with the Atlanta Fed nowcast pointing to second quarter growth of around 3% annualized, which is not recessionary in any way. But the composition of that forecast does matter. A large part of that resilience is coming from the consumer, and the consumer backdrop is becoming more fragile. Real wage growth has turned negative. Household savings are materially lower than they were during 2022 inflation shock. And higher prices, particularly in energy, are now acting as a taxation on disposable income. The point is not that the US economy is weak today. It's the margin of safety has narrowed. Growth is still positive, but the household sector has less capacity to absorb another shock. And that, for the portfolios, that matters because equity markets are not priced for much deterioration in consumption or earnings. The second issue is not new. It's the inflation saga, but there is some nuance and some new information that's sort of presenting itself. And the market has spent much of the past 2 years assuming that inflation would gradually normalize and allow central banks to ease. That assumption is now less clean. There are two inflation impulses operating at the same time. The first is energy, which is not new. And traditionally, or prior to the breakout of war in the Middle East and the blocking of the Strait of Hormuz, and then impacting the supply of energy and oil and gas, energy was disinflationary. Prices were coming down year over year, but now we've got this massive impulse that is impacting the global economy quite badly. But the second is a demand-driven inflation impulse, which is coming from the AI-related capital expenditure. The build-out in software, infrastructure, and compute is showing up in inflation measures in ways that actually matter to the Fed quite considerably, particularly because software has a much larger weight in the PCE measure than it does in CPI. The chart shows the problem clearly. Super core PCE, which is core services excluding housing, has come down from the 2022 peak, but it's stalled around 3.5%, and that's well above the Fed's 2% target. And importantly, it is no longer falling. The implication is that the Fed has less room to respond to market weakness than investors may be assuming. If inflation is sticky, and if the new Fed leadership is more hawkish, the old policy put, or the Fed put, is less reliable. The hurdle for rate cuts becomes much higher then. For fixed income, this creates a more nuanced environment. Bonds are attractive again because yields are materially higher, but duration needs to be managed carefully. We want to have exposure to quality duration as a portfolio stabilizer, but not as an undisciplined duration bet if inflation risk remains asymmetric. The equity market is not simply trading on hype, although there is a fair bit of that in the prices at the moment. The bull case does have some substance. The S&P 500 earnings expectations has been revised higher, and AI-related companies are delivering genuine revenue and earnings momentum. But the issue is the concentration. The upgrades are not broad-based. They are heavily concentrated in the AI infrastructure and a small group of the hyperscalers. That creates a market where index level earnings look strong, but the source of that strength is very narrow. So the chart here captures the structural risk. Hyperscalers now account for close to 40% of the S&P's capital expenditure, but less than 20% of its net income. In other words, they're spending much more capital, and their earnings profile is a lot lower. That may ultimately prove justified if AI can monetize and scale quick enough. But at these current valuations, the market's assuming a lot of future returns in that investment. The risk is not that AI is irrelevant. The risk is that the capital cycle gets ahead of the earnings cycle. And for professional investors, that distinction does need to be made. The correct conclusion, in my view, is not that one should avoid AI. It's that the AI exposure does need to be intentional, valuation aware, but also sized proportionately to the total risk of the portfolio. So this slide pulls the prior three together, hopefully. We've got a consumer that's still spending, but becoming more stretched. We've got inflation that's sticky enough to constrain the Fed. And we have equity markets that are showing really strong earnings momentum, but it's very narrow. So against that backdrop, the market is priced very optimistically. Risk appetite is in the 99th percentile, according to a Goldman Sachs measure. And the market breadth is incredibly weak, with only a small share of the S&P 500 stocks outperforming the index. And household equity exposure is at record highs. Now, that last point is quite important considering the fragility in the US consumer market. When you've got households that have 40% of financial assets in equities, any market weakness is no longer just an event in portfolios, becomes a potential macro transmission channel. And material equity drawdown can sort of feed back into confidence, consumption, and then ultimately impact earnings more broadly. At the same time, bonds now offer real competition. A 10-year treasury yield at 4.6% changes, the relative value equation. With risk-free rates, or when risk-free rates are high, I should say, the equity risk premium has a lot of work to do, and investors need to be compensated for taking that equity risk. And at current levels, that compensation looks quite thin. So, markets are not obviously irrational, but there are vulnerabilities that are showing up. It's priced on a very narrow path with resilient growth, contained inflation, but strong AI monetization and no policy shock in there as well. So that's a possible path, but it's not a low risk starting point. Taking a turn a bit more local, the cycle does look different here in New Zealand, slightly, but the underlying pattern is quite familiar. We had strong stimulus-driven rebound after COVID, but real GDP per capita has effectively gone sideways since 2022. And on a per person basis, the economy has made little progress over the last 3 years. So the RBNZ has already responded aggressively, with rates or the OCR at 5.5%, and that was cut in half progressively. We are in supportive monetary policy position. I guess the question is whether those cuts can actually generate enough domestic momentum before global conditions become restrictive again. Migration was another positive story. and we had a good surge with a lot of activity. Then that collapsed quite sharply. It has recovered modestly, but the impulse at the start has now faded. For the New Zealand investor, the key tension is this, in my view. Your local policies easing always has eased and is now sort of on hold, but global financial conditions are still being heavily influenced by the US. And if US yields remain high and the Fed stays hawkish, that can limit how much relief New Zealand receives through lower local rates. So New Zealand is, further through the slowdown in the cycle, as it were, but it's still not insulated. And domestic rate cuts help, but global inflation, which we tend to import, US yields, and risk appetite still matter for asset prices here. And then moving on to the funds, the Mint Diversified Income Fund returned 1.6% in May, with positive contributions from fixed income, the global equity piece, and the Australasian equities. Fixed income was the largest contributor, also given by its size in the portfolio, helped by the longer dated New Zealand and Australian government bonds in the portfolio. These were beneficiaries of yields coming down from their recent highs just after the outbreak of the war in the Middle East and the inflation shock. Credit also added value through carry and a sort of a modest spread compression, particularly in the high quality issuers such as Contact Energy and Transpower. It would also be worth noting that Wedge and the Trans-Tasman Bond Fund make up the fixed income component of the portfolio. Equities also contributed positively, but with that quite narrow performance in broad equity markets, but particularly the S&P. There were a few detractors over the month, particularly Boston Scientific and Charles Schwab. And then moving on to the Diversified Growth Fund, a good performance for the month, 3.2% in May, driven mainly by the global equity component, bringing in 2.5%, but the Australasian equities and the fixed income also contributed positively. Equity performance was led by no surprise, technology and the semiconductor holdings. But worth noting, Infratil was a major contributor there through the Australian share component. There were detractors, like the likes of AutoZone, and this was on the back of margin pressure and a softer consumer discretionary demand. And the Wedge Trans-Tasman Bond Fund brought in 63 bips to the portfolio. So that's it from me. Thank you for listening, and always please do get in touch if you have any further questions. I'm more than happy to discuss. All the best. Bye for now.